Good afternoon, everybody, and welcome to this webinar with Easy Equities. It's always great to talk to the community, and I'm particularly delighted today to be joined by Gareth Stobie from the team at ETFSA. Welcome, Gareth.
Hi, afternoon, Carl.
Now, Gareth, we've got very important people, the Easy Equities community, on this webinar, but we also have Narina Fisser, one of your colleagues, and she is what I'm going to call her the queen of ETFs in South Africa and well known to the Easy community. So best you and I do a good job, Gareth, in explaining this topic.
Indeed, indeed.
But it's great that you're with us. So thank you very much. And yeah, congratulations. You guys listed a new product yesterday. How did it go?
So far, so good, Carl. We this week is a book build week for us. The ETF is up and trading, but trading at a static value of 10 Rand until we invest the monies at the end of this week. And then the fund goes live in earnest from Monday next week. So we'll be blowing the kudu horn and doing all those sort of things at the JSE on Monday. Yeah, but the share's already up and trading. The share code is ETFSAB. So the in-house joke at the moment is that we're bringing South African breweries back to market, and that SAB sits inside the share code.
Well, it's not such a bad joke because everybody criticizes the JSE for having a lack of listings and people delisting, but there are a whack of ETFs and other products listing on the JSE. So there's a lot for us to put our money into.
Indeed. The ETF part of the exchange has been definitely one of the more vibrant parts of the exchange in the last couple of years. Not just ETFs, but your investors, Coral, might also be following developments in the AMC market, actively managed certificates, and just generally the ETF market has been a much more active space than the normal equities, where in fact we've seen a number of delistings. And for us, it's an exciting step in our journey. Up until now, we've primarily guided clients on research to do with the ETF market, providing regular performance surveys and that sort of thing, and also obviously managing portfolios for clients. But this is the first time we'll have our own products ourselves available in the marketplace.
Great. So before we talk more about the product which we're going to, why did you guys decide to do this, Gareth?
Well, a few reasons. We've been managing ETF portfolios for some time now at ETFSA, but we don't have a public track record like many asset managers do, where you have your fund in the public domain. Yet we've got certain strategies within our firm, such as those that we run for our retirement annuity, that have got really good, long, solid track records. And we thought that by launching our own ETF, it was a nice opportunity to showcase what we do at the company. Obviously, as our name suggests, we all about ETFs and in many ways have been a leader within the sector, but haven't had our own product. So this is our opportunity to launch our own product, to productize some of what we do in the market already. And once the product is listed, then it also means that we've got a broader community in which to engage. So, obviously very excited to be chatting to the Easy Equities community. It's a company I have great admiration for. If I reflect back on my CoreShares days, I remember CoreShares sort of got going around about the time Easy Equities got going, and there was we both sort of looked at each other across the table, sort of star-glazed, I suppose, in terms of where we were taking our respective ventures, and I've got sort of different. And have traveled different journeys over that period of time as well.
Yeah, but it's great. And it's wonderful to see how the retail investment space has grown. So because we've got clever Gareth from ETFSA here, who's put on a jacket for us, which I'm delighted about. He's also got a fantastic presentation. I'm going to interrupt you a little bit while you chat, Gareth. But I think maybe you want to get that up and let's get straight into what the hell an active ETF is, and a little bit more about why this one that you guys have listed is something that people should consider investing in. Yeah, we'll get right into it.
All right. Yeah. Thanks, Carl. And I'm pleased you picked up on the jackets. I did have a funky T-shirt to wear, but I thought that I wondered whether there'd be a bit of a dress off. So it's the tech savviness versus the business chick. So
it's a good balance, good mix. So
there you go. There you go. All right. So I think before we just dive into talking to everyone about our specific product, I think it's worth taking a step back and looking at the evolution of ETFs. I mean, certainly over the course of my career, the ETF product vehicle has just risen and risen in terms of it being a popular way of saving, not just in South Africa, but globally. And probably the most recognized brand with good reason in the local market is obviously Satrix. They launched the first ETF all the way back in the year 2000. And it was a bit of a breakthrough product at the time, hot on the heels of what was happening in Canada and America. And in fact, our own fellow director, Mike Brown, was instrumental in the development of that particular product. And if you look at what Satrix is, and just to give a bit of a lecture on kind of the construct of an ETF. I mean, what is an ETF? It is a collective investment scheme. So it's a unit trust. It's still, well-governed vehicle, a very recognizable savings vehicle. But the big difference with an ETF is it's obviously listed on the stock exchange. It trades as a share. So instead of having to fill in old-fashioned stop forms, you can simply click and buy the share in your Easy Equities account or in any kind of stockbroking account. So it's a share. When ETFs first came to market in South Africa, one of the rules was that the ETF had to track a particular index. And an index is basically just a set of rules. It's a representation of different types of markets. In South Africa, you have the JSE Top 40. In America, you have the S&P 500. In London, you have the FTSE 100 and so forth. So you had this fund that was a unit trust whose shares traded on the stock exchange and then very simply bought an index. So I'm going to carry on using the top 40. So obviously the Satrix top 40 is one of our best known products. And this way, this approach to simply buying the top 40, just simply holding those top 40 larger shares, has been called passive in inverted commas or rules-based. And because you're doing it so simply and so efficiently, the manager, being Satrix in this case, could charge a very low fee. In fact, that Satrix top 40 to this day is the lowest cost product in the market. It's got a 10 basis point TER, which by global standards is very competitive. So this part of the ETF market has grown. It is, to use Easy Equity speak, it has thrived, Coral, and over the years. It's got a number of dozens of listings of all sorts of different asset classes and regions. But the tech, so to speak, is over 20 years old now. And investors, as they have grown older and their investment needs have risen, so to have the product, the sophistication around the product wrappers, the rules and regulations that govern them have expanded and have become more flexible. So during the course of last year, the JSE announced that ETFs don't just have to track an index. They don't just have to track this sort of rules-based construct like the top 40. Actually, they can track whatever's allowed they will invest in whatever's allowed in a particular mandate. So if the mandate of a fund manager is, okay, I just want to, this is going to be a small cap fund with exposure to the small cap index, but it's going to be actively managed, and that's the construct of the mandates, well, then that mandate design can sit inside of an ETF. And it provides for much more flexibility to how the funds are invested, yet the units of that fund are still traded on the exchange as a share, and therefore it's still an exchange-traded fund. The only difference is that the regulator has asked that we call it actively managed ETFs. So in front of all the ETFs now, you see this AM, which stands for actively managed. And in terms of the costs, well, depending on how much work is going on inside this mandate, maybe it's just very subtle changes to the top 40 and then there won't be a very high fee. Or maybe there's a lot of work and a lot of IP and a lot going on within the mandate and a lot of skills and processes put behind it. And then sometimes the cost can be a bit higher. And because you're investing actively, obviously you need to pay a bit more attention in terms of what the funds invested in.
Yeah, I'm just going to stop you there. Why don't you go back to your previous slide? And thanks very much for taking
Sure.
the time to chat a little bit about that. I mean, have a lot of time for the team at ETFSA who are also big like us on education.
Yes.
And the whole team. So for the users, check out costs, do your homework. There are loads of resources at ETFSA, compare.easyequities.coza. So there's no excuse for not doing the homework. But I just want to ask you, we can take advantage of having Narina and also these AI assistants. I don't know what's more scary. But I mean, we've got hundreds of local ETFs. I mean, internationally, I think there are thousands of ETFs.
That's right.
And so active ETFs also are available overseas, correct? I mean, this is not unique to South Africa. So
Yes,
users find it elsewhere also.
that's right. We were, again, sort of 1 or 2 years behind the legislation elsewhere in the US, Australia, Europe, and so forth. In all cases, it's the same sort of idea. Those markets have also moved through time from having index-linked ETFs through to having much more open access mandates to clients. Yeah, so it is something that's grown internationally. It's still small globally, Coral. It's under 5% of all ETF assets sit within the active ETF space, but it's a part that's growing quickly.
Cool. Thanks for that.
All right. So just to maybe kind of extend it a little bit further. So as I say, there's pure index tracking, and then on the one side, and then you've got full active high costs. The manager doesn't tell you what they're doing at all. They've got the sort of secret sauce that they apply to the investment process. And then you also have certain funds that sit within the middle. So they are fairly rules-based, but they want the investor to know pretty much what they're doing, but they don't want to be boxed purely into an index. They just want to have some very light flexibility, but they want to remain transparent and let kind of the clients into the thinking at all points in time. And the product that we've brought to market sits in that middle ground where we're not passive, but we're certainly not hyperactive, where we're withholding kind of the secret sauce, so to speak. If we look at what's going on in the broader ETF market, it's exciting to see continued growth in the ETF market. Still some way off the traditional unit trust market, but growing quicker than the unit trust market. And it's expanded into not, we always talk about ETFs. We've called our firm ETFSA, but the broader category is ETP, standing for exchange traded products. And ETPs would encompass not just ETFs, but ETNs. So those are notes issued by the big banks that track particular investment assets. As I mentioned earlier, actively managed certificates, and now also actively managed ETFs. So the types of products are diversifying, and the market as a whole is increasing. So again, within a stockbroking environment such as Easy Equities, the choice of products has certainly expanded significantly over time. We're over 200 products now across the whole ETP landscape. And potentially, that having all of that choice is both a blessing and a curse, because as much as, Carl, you say there's great resources at investors' disposal, there is on our website and other websites, but it can sometimes become a bit overwhelming. I mean, where does one actually start? Which ETF should one buy? And I guess one can overthink it and then end up not doing anything, but you should get going. And, whereas before there were very simple products like the Satrix Top 40, which is obviously still available, other S&P 500 products, those are all perfectly good starting places. But what we've introduced is a fund that incorporates all of the major indices within one balanced construct. So it's got some SA equity as represented actually by the Satrix equity ETFs, global exposure as represented in the ACWI index, and so you nicely balance. So in a way, what I'm going to show you next around our fund is in essence a solution to the product proliferation that actually we're seeing in the ETF market in terms of trying to bring it back to a more simple easy starting point for investors. All right, so this is an extension actually of the benefits of active ETFs. I've kind of got ahead of myself, as I often do. But
I'll stop you if you're talking rubbish, so carry on.
Okay, thank you. I wish everyone would be as kind as you, Coral. Thank you. So, some of the further benefits of active ETFs is obviously, some asset classes like fixed income in particular become quite difficult to index. Certain parts of the bond market, the credit market, and so forth, they just simply aren't indices. That's further rationale for active ETFs. You get access to certain styles and skills in the market. So you'll, for instance, often hear of active managers calling themselves value managers and following a value style to investing. Now you can have an actively managed value ETF, for argument's sake. And then also looking at outcomes-driven type of solutions, which also is a nice lead on to what we're going to talk about in terms of our product. And that, when you're investing in individual ETFs, you don't always have a particular outcome in mind, but once you start putting solutions together, portfolios of ETFs, you can start dialing towards what your particular personal circumstances are, what your timeline is, what your end goal is, and so forth, and be more outcomes orientated with your investment. All right, so that's kind of the backdrop to active ETFs and what's been going on in our markets. I think we're well over 15, 16 ETFs now. Coronation is just this morning listed a couple more, so it certainly is expanding. And without further ado, maybe just to introduce our own ETF, which is the ETFSA Balanced Foundation Prescient AMETF. So apologies for the long name. I think marketing firms would have a heart attack if they spend more of their time, Coral, in regulatory rooms, because there's so much you have to include in a name, unfortunately. But what are the two words that you really need to focus on here is Balanced Foundation, because it tells you really all you need to know about what we're trying to achieve with this portfolio. We're trying to build a very simple portfolio that can sit at the foundation of your savings plan, that is well balanced and well diversified, that you've got some exposure to global markets, you've got some exposure to local markets, you've got exposure not just to equities, but to bonds and cash and property as well. And it's a long-term mandate, so it should be for investors with kind of 5 years and longer in mind, and it can sit at the foundation of, as I say, of your savings plan. So those are the two words that we take out of the presentation. So how's the portfolio invested? Well, 70% towards growth assets. So in asset management, growth assets are things where you concentrate on the capital growth and not on the income. So that would be equities, both local and offshore, as well as listed property, whereas defensive assets tend to be asset classes that, where the share price doesn't move around as much, but that give you a good income through time. So 70% growth assets, 30% defensive, and then you can see how that's split out between foreign equity, local equity, bonds, property, and cash. And as I say, the key words are foundational, sort of to anchor your portfolio. Some more information, it allocates across all of those global indices. When it comes to offshore markets, we use the ACWI index, which stands for All Country World Index. It literally has something like 9,000 shares in the index. So you're completely diversified over all global markets with a fairly heavy weight towards the US. The fund incorporates products offered by the other major ETF issuers. And this is an important component of what we've done here, is that over the years, ETFSA has fulfilled a research role in the ETF market. In fact, we've even housed kind of the awards ceremony for the local ETF market and analyzed all the different ETF issuers out there. And so when we've built our own product, this product has incorporated some of the household ETF brands such as Satrix, Signia, OneVest, 10X, and so forth. The portfolio already has a track record, as it's already been running within our RA fund, and it's done very nicely within that environment. And it's the first product of this type to list on the exchange. If you can imagine, going back to my Satrix 40 example, it's very difficult to have a solution fund that incorporates all of the major asset classes within one ETF that is rules-based. In fact, those types of indexes don't really exist. There were some very early versions of this type of strategy with the MAPS products, which ABSA launched and which Satrix have subsequently taken over. But those excluded, for instance, offshore allocations and were somewhat restricted in terms of how they were designed. Whereas this product has got a bit more flexibility, and as I say, it incorporates global exposure. The reason why we've got Prescient in the fund name is that the fund is housed under the Prescient white label Manco. Prescient is a well-known firm in the space. They provide this as a service. So they've got the middle office and back office to support us with the listing and the back-end operations. And then obviously everything in the ETF world is about costs. I mean, Satrix, as I was saying earlier, has got the lowest cost TER, but then you've also got funds on the other end of the spectrum that are quite high cost. This fund is completely balanced, as I keep saying, into the different asset classes, but it's still got a very competitive TER of just over 0.5%. And that competes very nicely with the local balanced fund industry, which tends to have products that are just over like 1%, sometimes even much higher, 2%, even more, and will compete favorably within that space. I just want to go back a slide in terms of sort of the use case and maybe just to harp on this sort of foundational aspect a bit more. Carl, I think there's really, when I think of the easy equities community, I'd imagine there's sort of two types of users out there. There are those who are new to investing, and I mean, you guys have been at the heart of democratizing investing for South Africans. You got probably more clients than any other asset manager or stockbroker by some margin. And inside the fold of that community will be lots of people who not really sure where to start. And as I say, for those investors, this is a perfect, if in doubt, foundational product because it's so well balanced across all these different asset classes. With the proviso that as an investor, you behave well with the product. And what do I mean by that? Is that you actually stay invested for the period of time that we recommend. So if we're saying you should invest for 5 years, then you really should invest for 5 years. That's not to say that we're locking you in for 5 years. If you buy today and you forget that you have to pay for something next week, you can sell the share. It's readily tradable. But the ideal timeline is for longer time periods of 5 years or more. Or the other type of user on the Easy Equities platform would be someone who's now built up a small fortune, however one might define that in your different lives, and might be invested across easy crypto, into US stocks, into different bundles, baskets, what have you, and has actually quite a sophisticated or complex investment strategy based on the reading and research and guidance that they have taken. Even in that instance, this product can still form a foundational aspect or an anchor to your portfolio in what's been dubbed kind of like in the US fintech circles as a core and explore type of approach. So your core sits in these very boring indices in a very balanced construct, and then you, by all means, you explore out into the world of NVIDIA and cryptocurrency and so forth. But you know that you're not going to sort of bet the farm on any of those individual investments. You're going to remain safe by having a chunk of your money inside the foundational type of product. All right, and that's pretty much all I have to say, because I want to leave it open to questions, Coral. I hope I haven't rambled on too much.
No, that's great. Thanks very much.
Yeah, but the share's already trading on the exchange. As I say, its share code is ETFSAB. It's trading at 10 Rand for the rest of the week, and then we'll be fully invested from next week.
Perfect. Thank you very much, Gareth. Appreciate all of that. And I'll kick off with a couple of questions of my own and from the users.
Sure.
So first one, is it available in a user's tax-free savings account?
Yes, it is. It's a collective investment scheme, which means that it qualifies for tax-free savings and also doesn't have any performance fees. So that's, again, one of the key sort of use cases for it. You know, often people, when they set up a tax-free savings account, they'll say, well, you know, I'm going to put in 500 Rand a month or 1,000 Rand a month. Now, it's very difficult to be fully diversified with 500 Rand, you know, even with the fractional shares and stuff that you guys offer. From an investment perspective, you want to be nicely exposed over a number of different asset classes. So it fits nicely within that construct.
Perfect. So we've seen a surge in our users investing in managed products, ETFs, unit trusts on the platform. We get about 750 million to 1 billion rands new cash onto the platform every month from the users, and a large chunk of that goes to managed products. Why do you think somebody should consider an active ETF versus a unit trust, or do you think there's room for both? And maybe talk a little bit about the differences.
Well, they're actually quite similar, really. I mean, a unit trust, you know, balanced fund unit trust, if you've got, you know, one of the big the Alan Gray balanced fund, for argument's sake, sitting on your platform, I'm not sure if it is, Carl, then you know, what's the difference between that product and this product? Well, this will be cheaper. It will have a lower total expense ratio. That's a good starting point. And it's very simple to understand, in that we're only holding those 5 asset classes, and we're holding them strategically through time, whereas Alan Gray will obviously be chopping and changing depending on how they see the market. Now, that chopping and changing, or how they guide that strategy through time, may well yield good results, or not, as the case may be. So kind of falls back to the whole idea between having kind of a core passive allocation, and then by all means, you know, having some active allocations alongside it, the whole sort of core satellite or core and explore, as I explained earlier. There is room for both. I guess, as I was trying to explain earlier, is we are trying to simplify things, because sometimes that choice can become quite overwhelming, and then, you know, people get almost too flustered and then don't make a decision. Whereas this has really been positioned to be as simple to understand as possible, whilst being well diversified.
Yeah, so I think you phrased it well. And also, I believe there's room for both. But a good starting point is to look at the costs, which obviously impacts. Yeah, see what you can be paying in those over years. You spoke about that one layer of the equities, and actively choosing those. Who does that? Is that a person, a team, AI? Who selects what goes in there?
Well, our team has constructed the strategic asset allocation. So, as I say, that's I had the startup earlier, but we'll say 35% to global equity. So once we've made the decision to say long term, in a balanced fund of this sort, we would like to have that 35% allocation. Then it's a case of, well, how do we invest that? And we've chosen to very simply buy the All Country World Index, which is obviously hyper diversified across all of the markets. So we're not doing any stock picking within that space. It's a very simple, straightforward index investment. And the same goes for the SA component, and the other asset classes as well. So no, there's no stock picking. There's no kind of micro analysis of the individual shares. We focused on the big picture asset allocation, and how do we get clients, you know, saving nicely for their long-term goals, and ensuring the right mix between growth assets and defensive assets.
Great, thank you. We've had a couple of questions around performance. You know, you're targeting CPI plus. You spoke about holding it for a period. And just by the way, if users need access to cash urgently for the emergencies that you mentioned, use Easy Credit. Don't sell your portfolio. There are lots of qualifying ETFs and related where people don't have to sell, and they can access credit through Easy Credit. To allow them, for instance, if they've decided to buy your product, to hold it for the 5 years. But assuming I hold it for the 5 years, are you looking at CPI plus what? What is the performance that you have in mind?
Yeah, so the long-term performance target is CPI plus 4 to CPI plus 5. So that's inflation plus 4% or inflation plus 5%. We're in about that range. But that is, you know, that's our target. That's how we've strategically set ourselves up. But we remain reliant on the underlying markets. I mean, obviously, we can't generate that return by ourselves. The markets themselves have to generate that return for us. So there'll be some years where we will significantly outperform that benchmark. Like the last calendar year, for instance, this portfolio returned over 15%, which was much more than CPI plus 4 or CPI plus 5. But there will be other years where you might woefully underperform even inflation. And that variability in returns is why the 5-year timeline is so important, because you really need to be invested for the full 5 years to achieve that CPI target. The fund, and I think I saw a question popping up asking about the performance. So I'll just go back there for a second, if you don't mind, Carl. So here's the performance slides over the last period. You can see 1 year, 3 years, and 5 years comfortably sort of, up round and over that 10% level, and comfortably above sort of the peer group comparison, which is the sort of the salmon pink type of bar. So it's amazing that by very simply strategically holding these 4 or 5 asset classes, you've been able to outperform, a vast category of active asset managers who are moving between bond markets and currencies and asset classes all the time. And this is really, old Da Vinci, I think it was, the ultimate sophistication is simplicity, right? This really is quite simple, yet very sophisticated actually in terms of what the outcome is.
Cool. Gareth, here's a question from somebody who says, should they invest a lump sum or should they invest monthly? So maybe you can just talk about that in terms of ETFs generally and this product specifically.
Both. I mean, that is obviously both is a good idea. Everyone should be encouraged to save as much as possible. As Narina was saying the other day, my colleague, you should be investing after you, or rather spending after you save, not save after you spend. So if you follow that philosophy in life, then you should be, every month kicking off with a debit order of some sort. And this is a nice product for long-term savings. So yeah, it's appropriate for either or.
Thanks. Those who've asked if it's available in your ZAR and your TFSA on Easy Equities, it's already in your ZAR, and it will be available in the TFSA, your TFSA account this afternoon. Gareth, talk to us a little bit about the difference between book build, 10 Rand, then what happens next week. Are people expecting a massive jump, a massive down? Just give people some sense of what that means, please.
Yeah, so it's a new product. In days gone by, when new ETFs came to market, they had what was known as an IPO process, where you would fill in a form, tell your stockbroker exactly which share you wanted in the quantum, and then there'd be quite a mechanical administrative process to have your money invested in the IPO. We're doing it slightly differently in that the IPO is kind of listed. So if you want to take part, you buy the share now, and it represents cash for the rest of the week. So it's just simply trading at 10 Rand this week. And then from next week, the fund will go live, and that all the money will be invested. So when you wake up 2nd of September, you'll start to see the ETF reflecting how all of those different asset classes are going.
Thank you. For those who've asked for some of the differences between the exchange-traded products that Gareth mentioned, they are all available on the Easy Equities platform, so ETNs, etc. And you can just go to blogs.easyequities.co.za to get some of the differences between those products, what they are. The AMCs, ETNs, ETFs, and now the active ETFs. Easy Equities has got its own Manco, and we'll also be listing a couple of active ETFs coming in November. And so, Gareth, I really look forward to
tracking that from our side, Carl. It's a great,
and I look forward to more from you guys and the products rolling out, because I think this is a very exciting product, and we've certainly seen the growth overseas. So I think it will do well here. I just want to make sure, I wanted to ask you about your view on you were very gracious about the Easy Equities app, so thank you for that. Any complaints, good things about our new version that launched this couple of days ago, 3.0?
No, I see you embracing the world of AI, which is very impressive, Carl. I think it's amazing how AI is shaping our lives more and more these days. I mean, I happen to have one of my social media feeds is I've got a premium account, so now everything I write on social media, it asks me if it wants to be rewritten in AI, which is improved my language immeasurably. I'm sure my English teacher is very pleased, and it shows you the sort of developments the world and sort of tools that are now available to you. So, your sort of AI basket that's spitting out recommendations on the back of what clients might be looking for is an interesting development within the fintech space. And I think a company, that has diversified as much as you have into all the different channels between, you mentioned credit and property and crypto and so forth, obviously simplifying the communication around all of that must be quite a challenge for your team. And I know you guys have been working very hard on that. Yeah, so Jeepers, well done on all the work that has been going on there over a while. And I know all of these deployments are hard work. So, and no doubt it's caused a few gray hairs, although you don't look any older. So
thanks. No, we love the feedback from the community that tell us where we're making mistakes so we can fix them. So it's been great, all the engagement. Yes. Thanks for that. Gareth got a question there for you, Gareth, around AI. Do you think it's making investing better, more complex, simpler? Are you going to trust AI for all your decisions, or should we stick to our activity?
Well, when I was discussing AI with an investment guy who I really, really respect, this was going back 3-4 years ago now. He did make the rather profound comment that an index or a market is, in a sense, already a form of AI, a form of intelligence. Because if you think of what the top 40 is, or the S&P 500, it's multiple, it's hundreds of thousands of participants all making up their own minds around what the value of something, and creating almost an artificial intelligence, in a sense, around the value of a particular market or a particular share. So perhaps a bit philosophical, but I think what maybe he was alluding to, and which I kind of go along with, is that sometimes with this AI, you can overthink things, and again, sort of pulling life back into its simplest form is sometimes perhaps useful. So for all that there is AI and all of this tech out there, sometimes these very simple indices like the top 40, like the S&P 500 and stuff, still holds a very valuable place in your savings approach. So I certainly wouldn't be handing over all my wealth to some AI robot. I'd want to be sure that I was sanity checking it. But yeah, I think clearly the world is going to be driven more and more by some of these developments, and some of it's going to be incredibly useful, and some of it one should approach with a bit more skepticism, I suppose, like a lot of technology developments.
Yeah.
Carl, I did see, so as we were chatting, I did see one question that I didn't want to go unanswered, because it sort of was a point of clarity around some of the returns I was reporting. So I mentioned, so the fund has, over extended periods of time, returned just over 10%. And I mentioned 15% earlier, even though the line graph didn't have 15%. 15% was the last calendar year, being the year of 2023, whereas the 1 year number I've just shown you would have been up until the end of July, so slightly different time periods. Last calendar year ended up being a good year for markets after, they bounced towards the end of the year. So just to clear that point up. Yeah.
And I wanted to ask you, as we start wrapping up, just around dividends. I love Kayla, and our team sends out mailers every month on dividends, and I always get my update from Narina when I can expect cash from my ETFs.
Yes.
We're going to get dividends from these active ETFs.
Yeah, I think most of the active ETFs have got distribution policies. So does ours. It's got a quarterly payout profile. Having said that, though, given that it's a 5-year time horizon, income isn't the focus. We want to build sort of long-term capital growth. So it will have a distribution, but it's not a income-centric portfolio, whereas obviously other portfolios like property portfolio would be. This is going to be more capital-orientated.
Great. So just a reminder to everybody, this is the ETFSA first active ETF. The code is ETFSAB. You can search for it. It's available in your ZAR account and your TFSA account this afternoon on Easy Equities. There's a book build happening at the moment, so you can participate. And I think, Gareth, you've given us lots of food for thought why we can absolutely consider active ETFs as an asset class in our portfolios, and then specifically the one that you guys are launching I like that summary in terms of it really being the base, the core for investors to look at. We wish you lots of luck with it. And
thank you, Carl. Thank you for
seeing you at the JSE next week.
No, likewise. Thank you. And thanks for the opportunity to chat to the Easy community, and wishing everyone well with their savings journey. And we'll be in touch.
And for all those who've joined, thank you very much and congratulations. I love bragging about the fact that Easy Equities retail investors are super smart, and the results after 10 years, we're 10 years old this year, speaks for themselves. The increased buyers in the managed products and ETFs, active ETFs. I wish us all lots of success on our investment journey. So thanks very much, Gareth from ETFSA, for joining us. Check out their first active ETF. I'm sure there will be more products coming from this stable. We wish you well, everybody. Thanks for joining.
Great. Thank you, everyone.